Hello, in this short video, we are going to see 2008 financial crisis. So first, let's see some key terms which are there. First is debt to income ratio. It means that the if you divide your debt outflow, monthly debt outflow, by your income. Let's say the income is 5,000 and monthly outflow of debt is 2,500. Then if you divide these two, you get 50% into 100 basically, and it will lead you to 50%. So 50% is basically the DTI. Banks prefer to give loans to individuals who have less than 35% of DTI. It may vary, but it is generally 35% less. Subprime mortgage. So this is the second key term. So if the banks are lending money to borrowers who can't pay back that money, that is called a subprime mortgage. Why they can't pay? They may be having poor credit history, or they have poor debt to income ratio. That is basically a subprime mortgage. If we create securitization, if we create a financial asset from these from these derivatives, or we pool these financial assets and create securities out of these, like bonds, and sell it in the financial market. This process is called securitization, and this is primarily done to pass the risk exposure from financial institutions to investors. So basically, if the individuals are not able to pay back the loan, the people who have purchased these securities, they are more at risk than the bank which initially given the loans to these people. So thereby the risk for the bank is reduced. Derivatives: any financial asset which derives value from an underlying asset is called a derivative. Financial speculation. So speculation is, so whenever we make any financial decision, it is based on the intrinsic value of the asset. It should be based on the intrinsic value of the asset, instead of speculating or guessing and betting on the financial asset. So this speculation is basically bad if in case we are doing investments, and that's what financial speculation is all about. Now let's see what has happened here. We had multiple people taking mortgages, we have people taking loans. This loan is getting pooled and a financial asset is created out of it. So we pool all these loans, create a financial asset, and then we sell it based on the expected return. It could be secured, super secured, mezzanine, unsecured, and the kind of profit or gains the investors are going to make would be in alliance with the kind of risk they are planning to take. So unsecured would be having more risk than the secured. So whenever these payments are made by this mortgage borrowers, the first people to get the money are the secured people who have taken the highly rated bonds basically, and the risk increases, thereby the profit also increases. And these are basically derivatives because their value is being derived from these loans, from these mortgages which were taken by individuals. Okay, so this is what is securitization. Now let's see what happened in 2008. So these are the loans which were given to multiple individuals to buy house, mortgages which were given, and lot of these loans were given without doing due diligence or ignoring the due diligence also. So it's a subprime, which means the people were not having enough money to pay back if at all something bad happens, and that's what exactly happened. So the first thing was the inflation started growing up, building up during the 2000s, early 2000s, and thereby before 2008 the Fed started increasing the interest rate. And the implication of Fed interest rate increase is that the interest which has to be borne by these borrowers will increase. And most of these mortgages were based on adjustable rate mortgage. It was not a fixed rate. So let's say it was a 3%, it became a 5% because it's adjustable, so it can increase any point of time, thereby leading to defaulting borrowers. They were not able to pay the money and they started defaulting, and this led to demand of house being decreased, value of house being decreased, and the value of CDOs being securities being decreasing. Okay, so this is basically a cycle which was which happened. And whom to blame for this cycle? So first thing is this lending which was done without doing any due diligence. So these lenders, these predatory lenders who marketed home ownership to people who could possibly not pay the mortgages, they are to be blamed. The investment gurus who bought these bad mortgages. So basically all the securities CDOs, the people or the investment gurus who asked people to purchase, or the banks who purchased, they are also to be blamed. The agencies which rated these CDOs or these securities highly, they are also to be blamed. They did not do any investigation, any regulatory duties when they rated them highly, thereby making investment people who had some money to put in the market being susceptible to all these losses which they were about to see. So primarily there are multiple theories, but primarily these three group of people are to be blamed. uh, Again, the same view in a different diagram. Multiple mortgages being taken. These mortgages are being pooled together, and residential mortgage based securities are created. They are sold in different tranches and rated as triple A, double A, B. All these are basically sold in the general market to corporations or individuals. And the low securities, because they are very bad rated, nobody wants to create. So the market gurus made new set of securities called CDOs with these bad, and these bad, they were in fact rated very bad. They were again re-rated in different tranches as triple A. The different security created and rated, though they were created from a bad uh, loan or bad pool of loans, still they were rated again highly. And then there was again bad thing, again created one more level of CDOs which was called CDO squared. So basically what we are seeing is that the bad rated securities being again restructured and given high rating, thereby threatening the investors deposit to be lost. So this was basically the problem. And now let's see the Lehman Brothers case, wherein they had to file for a bankruptcy. So before we go there, let's see some of the key terms. So liquidity crisis. So liquidity crisis is basically if the bank is not able to pay money to meet its financial obligations. That is called liquidity crisis. It is having a lack of cash, lack of liquid assets. Now the more bigger problem, insolvency. So if the debts are more than the assets for any financial institution, thereby, I mean, it will not be able to pay the debts. It's called insolvency, and insolvency can lead to bankruptcy. Bankruptcy, again, if in case a individual or a corporation is not able to pay its debts, they file for a bankruptcy so that they can be absolved of these debts, or probably some restructuring can be done. So that's a bankruptcy, and the court reviews and makes a guideline on what should be the further steps after the filing of the bankruptcy. Run on a bank. So if in case a large number of depositors go and start withdrawing their money from the financial institution simultaneously, that is called run on a bank. This happens when there is a truth or a rumor around this insolvency of the bank. So if there is this news that the bank is going to be insolvent, a lot of people will try to get their money out of the bank, which is basically run on the bank. Now, what happened in the case of Lehman Brothers? So they invested heavily on this mortgage-based securities, and the subprime crisis, which we discussed earlier, started happening. Borrowers started defaulting. All the securities which they had purchased, these purchases which were done, their values went down very, very sharply. All this news spread very widely. Worried investors started going to Lehman Brothers, and it led to a run, and thereby this insolvency started, wherein the debts were more than the assets which they had, and then they had to file for a bankruptcy. So this is a little overview on the 2008 crisis. Hope you liked. Thank you very much.